Hello and welcome to this fourth day of this third day of the session, which is practice to pass session of the paper F6 taxation Pakistani variant. Myself, Luqman Rafiq, I've been conducting this webinar, and today is the third day of the webinar. We are actually going to continue from where we left in the yesterday's session. So I'm actually going to give you a general idea about what exactly have we done in the yesterday's session. So we actually started off with the concept of income from business. So what did we do in the yesterday's session? That was income from business. We started off with the income from business and we discussed the various concepts relating to the business. We talked about the definition of the business. Then we talked about what is included in the income from business. Then we talked about the pro forma for the computation of the income from the business, which was we start from the accounting profit, which is the PBT. Then we add back few things, we deduct few things. So resultingly, we end up getting the income from business. Okay, so then we actually move forward and we discuss further and we talked about few of the key principles behind income from business. And we did discuss that the income from business key principles include that only those expenses which are incurred wholly for the purpose of business are deductible. Secondly, only real profits will be taxed. That is, I did talk about the fair value gain is not taxed. Similarly, only the trading receipts are going to be considered as income from business. The capital receipts are not going to be considered as income from business. So that is all what we did in the yesterday's session. Then we moved a bit forward and we started discussing further. So we talked about the other principles, and the other principles were that even if the amount is received, once you have concluded the business, then again you will actually have to pay tax on that. Then again you'll have to pay tax on that. So that's what we discussed. We moved forward and we talked about the various inadmissible deductions. So amongst the various inadmissible deductions, we did talk about that whenever we are talking about the computation of the income from business, there are few things which are not deductible for tax purposes. And those things are actually what? So we discussed everything that any cess rate, tax paid, etc., etc. All of these considered to be the non-deductible expenses. Then we moved a bit forward. We talked about the other inadmissible deductions. We talked about the cash payments, etc., etc. So this is all what we did. Then we talked about the other deductions. So the first thing that we did talk about was the scientific research expenditure. We said that if the business is incurring a scientific research expenditure in Pakistan, then such expenditure is actually deductible for computation of the income from business. Such expense is deductible for the computation of income from business. Then we moved a bit forward and we talked about the employee training facilities. We did discuss about the concept of the employee training facilities. We talked about it that in case if there is an employee and you are providing any training to that employee or any hospital services or anything, etc. So that is all actually going to be considered as exempt, or that is all going to be considered as deductible expense. I skipped the bad debts and I moved on to the other thing. So what I'm actually going to do now is I'm going to start discussing about the bad debts, that what is the implication of the bad debts in the taxation. Okay, so let's just start discussing about the bad debts, that how are the bad debts accounted for while computing the income from business. So let's talk about it, that how the bad debts are accounted for while computing the income from business. Now let's actually start discussing about it. The first thing that we do when we talk about deduction of the bad debt from the income from business is that remember what we do in accounting is that we deduct two types of expenses. One of them is the bad debt expense, or which is the bad debt written off. And the second thing that we do in accounting is the provision for bad debt. The second thing that we do in accounting is the provision for bad debt. Now, let's try to understand few things. That remember, whenever we are computing the taxable income, so we actually start off from the profit before tax, which is actually your accounting profit. So what the tax authorities they do is that they do allow the bad debt expense. They do allow the bad debt expense, but they don't allow the provision for bad debt. They don't allow the provision for bad debt. So what is actually going to happen is when we talk about the profit before tax, the accounting profit. So what you would do is that you would add back the provision for bad debt. So whatever the expense that you have claimed with respect to the provision for bad debt, that expense is actually going to be added up. That expense is actually going to be added up. So when I talk about it, we start off with accounting profit, we add back the provision for bad debt. Now, now the second thing is that that is a basic concept that you need to understand, which is that the tax authorities they don't allow the expense in relation to provision for bad debt. The only expense that they allow is the bad debt actually written off. Now, for you to claim the bad debt expense, that is when you have to deduct the bad debt. I'm repeating it again. For you to actually claim the bad debt, there are few things that are actually needed to be fulfilled before you can claim the bad debt. What exactly are those things? Number one was them is basically the amount of debt was previously included in the person's income from business chargeable to tax. Now let's try to understand this concept. For example, you are computing the tax liability for the tax year 2019. You made a sale in the current tax year. You made a sale in the current tax year. And you have realized that this sale which you have made is going to become a bad debt. So basically, if you realize that this sale is actually going to become bad debt, then what do you need to do? So what you actually need to do is that you need to simply claim the expense relating to this specific bad debt in the current year. Now, but the problem is that it says the debt was previously included in the person's income from business chargeable to tax. So in 2018, this income was not taxed. This is 2019. We have actually sold in the current year, and we are actually going to be recognizing the bad debt in the current year. So remember this thing that if you are accounting for on a cash basis, if you are accounting for on a cash basis, then you cannot claim bad debt in the current year. But if you are accounting for in an accrual basis and if the amount of bad debt is included here, then you can claim the bad debt expense, otherwise you cannot. So basically it's important that for you to claim the bad debt expense, you should have claimed a deduction in relation to that bad debt in the previous tax period, then you can claim it. Number two, there are reasonable grounds for believing that the debt is irrecoverable. Now remember, the bad debt is not just based upon your estimations. The bad debt is not just based upon your expectations. For you to recognize the bad debt, it is essential, it is important that you have reasonable grounds to believe that there is going to be a bad debt. You have reasonable grounds to believe that there is going to be a bad debt. If you don't have reasonable grounds to believe that there is going to be a bad debt, you cannot recognize bad debt. Now let's move a bit forward. It says the amount of deduction allowed to a person for a tax year shall not exceed what? Shall not exceed the amount of debt written off in the accounts of the person in the tax year. That means what happens is, for example, you have a receivable of let's say 100,000 and you have claimed bad debt in your accounting records of 75,000. But in the tax authorities, what you are doing is that you are claiming 100,000. So you cannot claim 100,000. You will not be allowed 100,000 rupee deduction. You can only claim 75,000 because you have claimed deduction of 75,000 in your accounting records. So if you have not deducted, you cannot claim deduction in excess of what you have deducted in your accounting records. So it's important. And also, if there is a subsequent recovery, how is it actually going to be dealt with? I need to explain to you through an example. In case if there is a subsequent recovery, how exactly are we going to handle it? I need to explain to you people through an example. Let's talk. So for example, let's assume that you have a receivable balance of 500,000. Now what happens is in tax year 2018, you claim the bad debt of, let's say, 500,000 from the tax authorities. The tax authorities allowed you only 300,000. Now what happens in tax year 2019, the amount is recovered from customer. Now I'm going to talk about two things. The amount recovered from the customer is 275,000. The amount recovered from the customer is 135,000. So these are the two scenarios, two situations which I have actually talked about. What? For example, you have a receivable of 500,000. There's a bad debt of 500,000 in 2018 in your accounting records. But what the tax authorities they do is that they allow you only 300,000 to be claimed. That means, in other words, I can say that the tax authorities have actually disallowed 200,000. The tax authorities have disallowed 200,000. Now, let's say in a subsequent tax year, which is tax year 2019, you have now recovered 275,000 from the customer, which is case number A. Now, if you have recovered 275,000 from the customer, which is case number A, so what exactly is going to happen? Let's try to understand. The authorities are going to tell you that, look, um, the recovery is of 275,000 and the disallowed amount is 200,000. So what happens is the 75,000 is a surplus that you have received and it has to be included in your income. The remember 75,000 has to be included in your income. Now why? The reason behind that is the original receivable was 500,000. Of the 500,000 receivable, 300,000 was claimed bad debt in the previous period. In the current period, 275,000 is recovered. So if 275,000 is recovered, the amount that was disallowed was 200,000. So resultingly 75,000 income is actually recognized. Now what next is there? The next situation is, which is case number B, where you are actually being told that you receive 135,000 in total. Now, if you receive 135,000 in total, then what is actually going to happen is, we are going to say the recovery is 135,000 and the disallowed amount is actually 200,000. So resultingly what is actually going to happen is, you have got 65,000 which is going to be allowed as a further bad debt expense. Why? Because out of the 500,000, 300,000 was claimed in the previous period, 200,000 was claimed as the bad debt in the current period, and the remaining 65,000 is to be, 300,000 was claimed in the previous period, 135,000 is recovered, and that confirms that the remaining 65,000 is not going to be recovered. So you are allowed to claim additional expense of 65,000 in the current period. Now, is it okay to everybody? Is it okay to everybody? Okay, let's move forward. So we have talked about the concept of bad debt, that how the income tax rules allow the bad debt to be recognized. Let's move a bit forward and let's talk about the next aspect, and that is called the depreciation. First of all, we all know the way the depreciation is computed on an asset as per the accounting rules. But what is the criteria for recognizing the depreciation as per the taxation rules? So let's try to understand that how the taxation works. Now let's just start discussing. The first thing is when we talk about the concept of depreciation as per the taxation rules. So the depreciation is actually charged on the depreciable assets. Now what exactly are those depreciable assets? It says the depreciable asset means any tangible movable property, any tangible movable property, immovable property, other than unimproved land. Now what do you mean by unimproved land and what is an improved land? So basically, if there is a land on which you have done some improvement, like installation of the NV blocks, so installation of blocks or something, so that the land becomes converted into a land which is basically where what happens is you've got a proper floor, so that is called an improved land. That the installation of the floor is the improvement to the land. So number one point is, if we have got this unimproved land, so what exactly do you mean by unimproved land? The word unimproved land actually refers to a situation that a land on which no work has taken place, a land on nothing has happened, that is called unimproved land. Now let's talk. So basically what happens is, other than unimproved land or a structural improvement to immovable property owned by a person. Now very important point, owned by a person. So as per the taxation rules, the only thing that can allow you to claim the depreciation is when you own the property. If you don't own it, you cannot claim it. Like when we talk about the accounting standards, we are able to claim the depreciation for even the assets that we don't own. Like in IFRS 16 leases, we can recognize the right of use of the asset and we can depreciate it. But in the taxation rules, you can't do it like this. For the taxation rules, you need to own it. You need to own it. That's important. Now what next is there? So depreciable asset means any tangible, movable property, immovable property that has a normal life exceeding 1 year. So the life has to exceed 1 year. That's important. Is likely to lose value as a result of normal wear and tear and obsolescence, and is used wholly or partly in deriving income from business chargeable to tax. So these are the important things. What are those important things? The number one of them is it has to be owned property. Number two should have a normal useful life of more than 1 year. Third thing is it's expected to have a normal wear and tear. And the fourth thing is that it is used for the business. It is used for the purposes of business. Now, these are the rates of the depreciation that are being given. So all that you need to do is that remember one thing, that depreciation on all assets is actually charged on a WDV basis. Remember, the depreciation on all assets is charged on a WDV basis. That is the reducing balance basis or a WDV basis, and these are the tax rates that are given here. Now let's try to understand few things with respect to depreciation. There are few rules of depreciation that you need to follow. Number one, the depreciation is to be charged on a WDV basis. That's number one. Full year depreciation in the year of the acquisition and none in the year of disposal needs to be charged. None in the year of disposal. Then the third thing is, if asset is used for personal purpose, then depreciation is to be apportioned between personal use and business use. So in case if you are actually using the asset for personal purposes and for business purposes, then it needs to be apportioned. It says asset to be always depreciated as if it was in business use. Asset is to be always depreciated as if it was in business use. Now what is it? I'm going to explain it in a while. It says upon disposal, gain or loss to be calculated and adjusted for depreciation not allowed due to personal use. So we're going to do it again. And then there is this vehicle not plying for hire. So I'm going to explain that also. Now let's try to understand few things. First of all, okay, assume that you bought a computer for 400,000. The computer is actually used for both business and personal use. You bought a computer for 400,000 and it's used for both business and for personal use. Now what next is there? Basically what next is there is that um, in third year it's sold for 200,000. In the third year it is sold for 200,000. The personal use is 40%. Now let's try to understand that how exactly are we going to account for this whole. So we are being told that there is a computer which is worth 400,000. It's used for both business and it's used for both personal purposes. In the third year, the computer was sold for 200,000 and the personal use of the computer was 40%. Now, how exactly are we going to account for it? So let's try to understand this. The first thing that you are going to do is you're going to say that we are going to depreciate it as if it's used wholly for the purposes of business. Like this is year one. So what happens is the cost was 400,000. The depreciation which is on the computer is at 30%. So it's going to be 120,000. Resultingly 280,000 is what the carrying amount or the WDV at year one end. So the WDV at the year one end is going to be 280,000. Now what next is there? The next situation is going to be in the year two. What happens is the depreciation is going to be at the rate of 30%. So if I say 280,000 into 30%, that turns out to be 84,000. So if I talk about it, what happens is we have 196,000 as a WDV at year two end. Now let's try to understand. The depreciation that you can claim is actually 120,000 into 60% that can be claimed for the business purposes. And into 60% here, that is what is going to be claimed in the business purposes. So basically what happens is it's going to be 72,000 that's going to be claimed here. And it's going to be 50,400 which is going to be claimed here. So 72,000 and 50,400, that is what is actually going to be claimed. Now, so what happens now is that if we are gonna sell it, so let's try to understand that how exactly are you going to calculate the gain or loss on disposal on it. For example, now if you dispose it off for 200,000, the WDV at the time of disposal was actually 196,000. So we actually have a gain of 4,000. But the calculation of this gain is not correct. The calculation of this gain is actually not correct. Now you would say, why is it not correct? Let's try to understand this. the calculation of the gain is not correct. Now, why is it not correct? Let's try to understand. Basically, what is going to happen next? We were only allowed 60% of the depreciation. So remember, you would depreciate the asset as if it was used 100% for the sake of business. But at the time of computation of the gain or loss on disposal, you would make an adjustment for the amount which was not allowed. Now how? Let's see. So basically what happens is, you would say the disposal is 200,000, the WDV is 196,000, and there are few adjustments. Now when you talk about the adjustments, so you've got year 1 and you've got year 2. So it's 120,000 multiplied by 40%, and then it is actually 84,000 into 40%. So 120,000 into 40% and 84,000 into 40%. So what is it going to be? Now let's talk about it. So if I say it's going to be 120 into 40%, so 48,000 is what is not allowed here, and then 33,600 is what is not allowed here. So let's talk about it. 196 plus 48 plus 33.6. So this actually gives you 277,600. So instead of the gain on disposal, there is now going to be a loss on disposal of 76,400, 77,600. There's actually going to be a loss on disposal of 76,400. Try to see this thing. Yeah, let's try to see this so that you can have a better understanding. Yeah, anyone has any issues with it? Okay, so we have calculated this. Now let's move a bit forward. So we understood one of the concept, and that concept was basically that whenever you have got an asset which is used partly for the business use and partly for the official use, then you don't claim depreciation for the 100% of the cost of the asset, but you only claim depreciation. You are only allowed to claim the depreciation expense for the proportion the asset is used for the purposes of business. But the depreciation is going to be calculated as if the asset was used 100% for the purposes of business. At the time of disposal, the gain or loss on disposal needs to be adjusted. At the time of disposal, gain or loss on disposal needs to be adjusted. And the gain or loss on disposal needs to be adjusted for the adjustment relating to the depreciation disallowed due to. For depreciation disallowed due to what? Due to personal use. Okay, now let's move forward and let's start discussing about another aspect. There's another aspect which is basically vehicle not plying for hire. Now, what happens is it's rather a very vague concept. The law needs to be updated But unfortunately, till the time the law is not updated, we need to study this concept. So basically, what exactly is this concept? The concept is that the concept that needs to be understood is that in case in case if you buy a vehicle and the value of the vehicle is more than 2.5 million, in case if you buy the vehicle and the value of the vehicle is more than 2.5 million, then the tax authorities are not going to allow you depreciation on the entire cost of the vehicle. They're only going to allow you depreciation for the vehicle up to 2.5 million. They're not going to allow you depreciation for the entire cost of the vehicle. Now, why is that so? The reason behind that is this provision was introduced around 4 or 5 years ago, and the objective of the provision was that basically it was normal. I mean, the 2.5 million was a very high price for a vehicle because normally the vehicle was 1.5, 1.8, 2.1. That is what the maximum vehicle was worth. But now even if you buy a Corolla or even if you buy a Civic, which is a normal executive vehicle, that goes beyond 2.5 million. So anyways, the government, as per the FBR, as per this rule, has restricted a business that if you have an asset, if you have a vehicle which is not plying for hire. Not plying for hire, what exactly do you mean by not plying for hire? Not plying for hire actually means that this is not used for the transportation. This is used for the business purposes. This is not used for transporting of the people. So if there is a vehicle, like for example, if you are a bus transport company, then being a bus transport company, you are having a vehicle which is plying for hire. But if you're not a bus transport company, if you are a normal business company, then what happens is if you buy a vehicle and that is not plying for hire, you're not running it for the hire purposes, then you cannot claim depreciation on the entire cost. The maximum allowed amount is 2.5 million. Now let's try to understand. It says the depreciation is going to be restricted to 2.5 million. What is it? The depreciation is going to be restricted to 2.5 million. Now let's try to understand this. If the depreciation is going to be restricted to 2.5 million, how exactly are we going to account for this? Let's try to understand. You're going to account for this like this, that basically, for example, if there's an asset whose cost was, if there's an asset whose cost was 4 million and you are depreciating it at the rate of 15%, which is generally the rate. I think 15% is the rate if I'm not wrong. Yes, 15% is the rate. So 15% is the rate at which you are depreciating it. So basically what happens is the tax authorities say that you cannot claim depreciation on 4 million. The maximum you can claim depreciation is 2.5 million. So basically 2.5 million, you will be allowed to claim 15% depreciation on this. So it is actually going to be 0.375 million. So resultingly, you will have 2.125 million as the WDV at year one end. Now, for example, assume that you dispose of this asset for 3.8 million. You dispose of this asset for 3.8 million. So resultingly, what happens is the gain on disposal is going to be quite high. Now, what is the gain on disposal going to be? It's going to be 1.675 million. But think from the perspective of the taxpayer, it is actually going to be unfair to the taxpayer. Think from the perspective of the taxpayer, it is going to be unfair for the taxpayer. Why? Because when he purchased the asset for 4 million, the maximum cost that you allowed to him was 2.5 million. You did not allow him 4 million. Now you are allowing him to actually claim depreciation on only 2 million and charging him gain on the entire cost. So in order to cover up this issue, what the tax authorities they did was they introduced a concept, and the concept that they introduced was they said that the gain or loss to be calculated accordingly in this specific manner. Okay, so the gain, basically what is actually going to happen is the consideration is going to be adjusted. How? 2.5 million is the cost that we were allowed. The actual cost was 4 million. 2.5 divided by 4 multiply by 3.8 million, which is the disposal proceed. So the adjusted disposal proceed is going to be 2.375. You compare this with the WDV and you get a gain of 0.25. So now it makes fair for the taxpayer that he's only going to pay tax on 0.25 million. Now, so now let's actually move forward and let's start discussing about the another aspect of this depreciation. There are two specific concepts that are mentioned here on this specific slide. And what exactly are those two concepts? One of them is basically it says for computing the gain on disposal of immovable property, the consideration received shall be treated as the cost of the property if the consideration exceeds its cost. Now, a very important principle. A very important principle for computing gain on disposal of immovable property. Not about a movable property, it's about an immovable property. Remember, we are talking about depreciable assets, and depreciable assets are those which are used for the purposes of business. So, for example, you have an asset which is being used for the purpose of business. Then what happens is if you are calculating the gain on disposal of an immovable property, then um, the consideration received shall be treated as cost if consideration exceeds its cost. Like, for example, case number one, the original cost was 1 million. The depreciation which was accumulated was 0.4 million. So the WDV was 0.6 million. Now you dispose of this asset, and when you you dispose off for, let's say, 0.9 million. If you dispose of for 0.9 million, then what happens is the WDV of 0.6 million needs to be deducted, and you would have a gain on disposal of zero point 0.3. That's how the gain on disposal is going to be calculated. But if you dispose it off for, let's say, 2.2 million, so the tax authorities, they say that if you are disposing it off for 2.2 million, this is exceeding its cost. So now what you need to do is that you now need to adjust, you now need to treat this disposal proceed as its cost. You now need to think that the cost is also 2.2 million. So therefore the WDV becomes 1.8. So now it says the WDV is 1.8, resultingly the gain is going to be 0.4 million. So remember, if you dispose of an asset at less than WDV, if you dispose of an asset at an amount which is less than its less than its cost, then normal gain or loss on disposal is calculated. But if you dispose of an asset and the disposal proceeds are in excess of its cost, then such disposal proceed is going to be treated as its cost and the gain or loss is going to be recognized accordingly. Is it clear to everybody? The example, is it clear to everybody? Okay, I'm going to repeat it again. See this. You had an asset which had a cost of 1 million. The depreciation was 0.4 million, so the WDV was 1.8 million. Now what next? The next situation is basically you dispose of this asset for 0.9 million, and when you dispose of this asset for 0.9 million, the WDV of 0.6 million is there, so you get a gain of 0.3 million. You get a gain of 0.3 million. Now let's try to understand what happens next. The next thing that actually arises is, in case if you dispose it off for 2.2 million, then 2.2 million exceeds the cost. And the law says that if the consideration received shall be treated as cost if the consideration exceeds its cost. So here the consideration exceeds the cost of 1 million. So what happens is this consideration of 2.2 million is going to be treated as the cost of the asset. So like if I treat this as cost, which is 2.2, the WDV becomes 1.8. Now my gain on disposal is going to be 2.2 minus 1.8, which is 0.4. So if I can actually explain to you in simple terms, I could simply say that in case if such a situation arises where where the consideration received exceeds the cost, then gain is going to be equals to the depreciation charged. And the gain is going to be equivalent to the depreciation charged. Okay, let's move forward. Now let's talk about another aspect, which is basically where a depreciable asset that has been used by a person in Pakistan is exported or transferred out of Pakistan. Is exported or is transferred out of Pakistan, then what happens is then what happens is um, it says the person shall be treated as having disposed of the asset at the time of export or transfer for consideration equal to the cost of the asset. So it's more or less the same concept, except that you just need to remember that if you have actually disposed of or exported an asset out of Pakistan at whatever price that is, the gain is going to be equivalent to the depreciation charge of the accumulated depreciation. The gain is going to be equivalent to the accumulated depreciation. That's it. Okay, so that's how it is. So basically, we are done with the aspects of the depreciation in the computation of income from business. Now there is very important aspect which we need to discuss now, and that is called initial allowance. Now what exactly do you mean by initial allowance? That's a very important concept which we need to understand. Basically what happens is, let's try to understand the concept. Now the concept is basically what happens. For example, you are doing a new business. Usually when the business starts, the first year or first few years are very difficult time period, because there is an ample amount of capital outflows. There's an ample amount of capital investment. So generally what happens is a business owner is usually having a cash flow problem. Whenever the business owner he arises, he is having a cash flow problem. Now let's try to understand something. What actually happens is, um, if you start a new business, if there is a first year of the business, you usually have a cash flow problem. So the FBR has given leniency to the taxpayers who are doing business with respect to their profit computation in the first year. How? Let's try to understand. Basically, FBR says if you invest in a plant and machinery, or if you invest in building, then what happens is in the first year, in the year of acquisition, we'll allow you two things. Number one of them is we are going to allow you initial allowance, plus we'll allow you depreciation. Now, what do you mean by initial allowance? So when we talk about the initial allowance, we are being told the initial allowance shall be 25% for plant and machinery and 15% for building. Now, I'm going to demonstrate this through an example. Assume that you have purchased a plant and machinery, and the cost of that plant and machinery is, let's say, 900,000. So what happens is you are going to be allowed an initial allowance at the rate of 25% on this plant and machinery. And if you're going to claim 25% initial allowance, so that's 225,000. That means resultingly what happens is you get 675,000 as the WDV, and this is actually the first year in which you are allowed this. And similarly, what is going to happen is you'll claim a depreciation at the rate of 15%. The depreciation of 15% is going to be claimed in the same year in which the initial allowance is going to be claimed, 101250. So resultingly it's 573 750. 573 750. Now let's try to understand this thing. Basically what happens is plant and machinery, initial allowance 675,000, depreciation at 15%, this, and then WDV at year end. So basically in the first year, the expense that you are going to claim is going to be 326,250. The expense that you are going to claim is going to be 326,250. Okay. So do you get the concept of initial allowance? Yes, do you get the concept of initial allowance? Okay, now let's move a bit forward and let's just start discussing further. So basically, is this initial allowance going to be claimed on every asset? The answer is no. So what are the assets on which this initial allowance is claimable? So basically, initial allowance is claimable on an eligible depreciable asset. What is the definition of an eligible depreciable asset? What is the definition of an eligible depreciable asset? When we talk about eligible depreciable asset, so the definition of eligible depreciation asset actually means an asset other than, that means all of these things are not included, other than any road transport vehicle unless vehicle is plying for hire. Okay, now so let's talk about it. So basically what happens is, what is an eligible depreciable asset? It says means the depreciable asset other than any road transport vehicle unless vehicle is plying for hire, any furniture and fitting, any plant and machinery that has been used previously in Pakistan. So now let's try to understand this thing. Basically what happens is, if I simplify it, a building qualifies the definition of eligible depreciable asset, and a plant and machinery, if not used in Pakistan, like for example, a new plant and machinery is purchased. For example, a new plant and machinery is purchased. When a new plant and machinery is purchased in Pakistan, that becomes an eligible depreciable asset. But if a used plant and machinery is purchased in Pakistan, it's not an eligible depreciable asset. That's number one point. Number two, if used plant and machinery is imported, then that used plant and machinery becomes an eligible depreciable asset because it has been used, but it's used outside Pakistan. It's not being used in Pakistan. So it's actually, this is how things are. So basically what happens is, you need to try and understand this thing, that what exactly is the concept of an eligible depreciable asset. So when I talk about the concept of eligible depreciable asset, it's generally the buildings and the plant and machinery which has not been used in Pakistan. So if you invest in these, you're allowed an initial allowance. The initial allowance is 15% on buildings and 25% on plant and machinery. So basically in the first year, you get two things, which is basically 25% for the plant and machinery and 15% for the buildings. And then you get WDV also. So that marks the conclusion of the concept of initial allowance. We are done with pre-commencement expenditure. We're now going to move forward and going to discuss further. So the next aspect of the business is basically the concept of intangible assets. Let's try to understand that what exactly is the concept of intangible assets. Okay, so we're done with pre-commencement expenditure. Now let's try to understand the next aspect. What is the next aspect? The next aspect is basically the concept of intangibles. Um, I'm going to explain to you one thing, that remember, the rules prevalent in accounting are different and the rules prevalent in taxation are different. So when we talk about the rules prevalent in accounting and taxation, so now here comes the difference between the intangible. Now, what exactly is going to be the difference between intangible? Let's try to understand. Let's try to discuss. So the definition of intangibles is basically like this. It says intangible means any patent, invention, design, or model, secret formula or process, copyright, trademark, scientific or technical knowledge, computer software, motion picture, films, etc., etc. These are all things that we know as per IS 38 also, because they are intangibles. But a very important aspect of the definition of intangible is basically this. And any expenditure that provides an advantage or benefit for a period of more than 1 year. That's a very important concept. Now, why is it a very important concept? Let's try to understand this. Basically, this is an important concept because what happens is when we talk about any expenditure that provides an advantage or benefit for a period of more than 1 year, let's try to understand this. For example, you have incurred a marketing expenditure, you have made an ad, you have prepared a marketing, you've incurred marketing expenditure. And when you have incurred marketing expenditure, so what you actually do is that you say that the marketing expenditure is going to give us benefit for a period of more than, let's say, 12 months, for 2 years, for 3 years, for 4 years. So as per the income tax ordinance, such marketing expenditure can be recognized as an intangible. Although for the accounting purposes this is not an intangible, but for the taxation you can recognize it as an intangible. For taxation you can recognize it as an intangible. So basically we have got a definition of intangible. Now, so once you have an intangible, how do we actually deal with the intangible? So remember, the intangible is going to be amortized for the tax purposes. How exactly is the amortization going to take place? So the amortization is going to take place in a manner which is a bit different to the way depreciation is recognized. When we talk about depreciation, we say depreciation is recognized. Whenever we talk about the depreciation, we say that depreciation is recognized full year in the year of disposal and none in the year of full year in the year of acquisition and none in the year of disposal. But if you talk about intangibles, the way amortization operates is that it says that the intangibles amortization is going to be recognized. The intangibles amortization is going to be um, the amortization is going to be recognized on a time proportionate basis. What? On a time proportionate basis. Number two, in usually what happens in accounting is that what we do is that we say that if an asset has an indefinite life, usually in accounting what we do is that if an asset has indefinite life, we don't amortize it. But for the taxation purposes, FBR's rules or the income tax ordinance, it says that irrespective of the fact, I'm repeating it, irrespective of the fact whether the life is definite or indefinite, you have to amortize. The only difference is if the life is indefinite, then you amortize it over a 10-year period. And the third thing is, if the life is more than 10 years, if the life is more than 10 years, then amortization is to be restricted to maximum 10 years. So for example, you have an intangible that has a life of 14 years, you're going to amortize it over 10 years only. You've got an intangible which has a life of 14 years, you're going to amortize it over 10 years only. I hope that this is clear to everybody. So we have talked about the intangibles and we have talked about their amortization and all. So basically, that marks the conclusion of the broader major concepts of income from business. If anyone has any questions, any problems, anything that you need to ask, please do ask so that I can then move forward. Okay, so we have actually concluded this specific concept of income from business. Now, there is another aspect which I actually need to explain to people. So, I'm actually going to discuss that. That aspect is not covered in my presentation slide. So, I am going to cover it up through some other area, and that is basically the concept of speculation income. So I'm going to cover another area in the income from business, and that is called speculation business. So I've got income tax ordinance in front of me, and from the income tax ordinance, as you could see that there is section 18 which is about income from business, and then you've got section number 19 which is about income, which is a speculation business. Okay, let's actually try to discuss what exactly is the concept of a speculation. So I'm going to explain to you accordingly so that we can have a better understanding of a speculation. Basically, speculation means a situation where, um, if I could explain to you in a normal manner, is basically what happens is when you enter into a transaction which is not going to benefit you directly into your business, then such a transaction is generally considered to a speculation transaction. For example, if we say that where is it, what does the law say? It says where a person carries on a speculation business, that business shall be treated as distinct and separate from other business carried on by the person. So when we talk about computation of the income from when we talk about computation of income, so income from business is computed separately, and income from a speculation business is computed separately. So basically, if you talk about the computation of income of XYZ, so what happens is the business income is computed separately and the speculation business is computed separately. The business income is computed separately and the speculation business is computed separately. So it says that the business shall be distinct and separate. It should be distinct and separate. It also says the part shall supply separately speculation and head of income from business, so and so, so and so. Now, Now, what exactly is a speculation business? So let's talk about the definition of speculation business. It says means any business in which a contract for the purchase and sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by actual delivery or transfer of the commodity. Now, very important point. So the basic principle of the speculation business is that the settlement is without cash. The settlement is without cash, or by the settlement is without actual delivery. Like for example, you go to a stock exchange and you deal with a stockbroker and you tell him that buy shares of XYZ company for me. He buys the shares of XYZ company for you for 100. And what happens in 3 days' time, you tell him. In 3 days' time, you tell him that he should sell those shares. When he sells those shares, they are being sold at 112. Now, what happens is you get 12 rupee per share as a gain or as a benefit. Now, this is actually called a concept where you don't get the actual delivery. Instead, you take a net settlement in cash. Similarly, it could have gone this way also, that you purchase the share for 100 and 110, and when you sold it, the share was actually sold for, let's say, 103. So there's going to be a loss of 7, and the net cash is paid to the broker. So remember, when we talk about the speculation business, the basic concept in the speculation business is that whenever you talk about a speculation, the speculation means that there is going to be a settlement which is other than the actual delivery of the goods or commodity or etc. or shares whatsoever. The actual delivery is not going to take place. Also remember that there are situations where even if you are not taking the actual delivery, even if you are settling on a net basis, the following are not included in the speculation, but instead are considered as income from business. Now, what exactly is this? A contract in respect of raw material or merchandise is entered into by person by course of in the course of manufacturing or mercantile business to guard against loss through future price fluctuation. Number two, a contract in respect of stocks and shares is entered into by a dealer or investor to guard against loss in the person's holding of a stock. A member of forward market or stock exchange, the course of any transaction in the nature of jobbing, which is arbitrage, to guard against any loss which arises in ordinary course of person's business. So remember, if you are entering into a speculation transaction, and the purpose of entering into a transaction is to protect yourself against the loss in the normal course of business, then such a transaction is not going to be considered as a speculation business, and instead it is going to be considered as a normal business transaction. So basically what happens is, remember, like for example, if I talk about it, let's say there is a textile mill, and a textile mill is obtaining cotton futures from the mercantile exchange. Now we'll see what exactly is the objective behind obtaining these cotton futures. Assume that the textile mill says that the objective behind obtaining the cotton future is basically to gain from price fluctuations. If such is the case that they want to gain from the price fluctuations, then this is going to be considered as speculation. But if they want to guard against loss, then it is going to be normal business. Then it is going to be normal business. So if they want to guard against the loss, then it's going to be normal business. Is it okay to everybody? So basically what happens is the speculation business and the normal income from business needs to be separated. Now, a very important concept that you need to understand also. Now, what is the next concept that you need to understand? The next concept that you need to understand is basically there are at times common expenses. Like for example, a business accountant. For example, you've got a common accountant in the business. So like for example, if the accountant is common, then what happens is you need to allocate the cost of the accountant to the normal business and to the speculation business. How exactly are you going to do it? So it could be done on the basis of sales. Like for example, 40,000 is the salary of the accountant. The normal business has sale of 40 million. The speculation business has a sale of let's say 5 million. So what you are going to do is that the cost of accountant is going to be allocated on the basis of relative sales. How? 40 upon 45 multiplied by 40,000. Then you've got 5 upon 45 multiplied by 40,000. Is it okay to everybody? So now you get the difference, you get the concept of a speculation business also. Okay. So basically this is what we need to understand. So we are now done with the concept of income from business. We are now going to have a break, and after the break what would happen is we are now going to start off with the income from property. Okay, so welcome back, and let's start discussing further. So before the break, what we had done was we had actually discussed about the income from business. Now the next topic that I'm actually going to move on to is the income from property. So that's the next head of income, which is the income from property. Income from property. Now let's just start discussing about the concept of income from property, that what exactly is income from property. So before I start discussing, I'm going to explain to you two things. Number one of them is basically that there are two aspects to the computation of income from property. Now what are those two aspects when it comes to the computation of income from property? So one of them is basically the computation of income from property for an individual or AOP, and the other one of them is for a company. So in the first phase, what I'm actually going to discuss is going to be the income from property from the perspective of individual or AOP, and then at a later stage I'll discuss about the company. Now let us start discussing about the income from property. One of the very important aspects of any income computation that you would actually enter into is to understand the concept whether it is taxable on a receipt basis, or it is taxable on a cash basis, or it is taxable on accrual basis. How exactly is it taxable? That's a very important aspect that you need to understand. So when we talk about the income from property, so the income from property actually means the rent received or receivable, the rent which is received or the rent which is receivable by a person for a tax year other than rent exempt from tax shall be chargeable to tax in that year under the head income from property. So the rent that you received or the rent which is receivable in respect of the property which is owned. The important concept is property which is owned. In respect of property which is owned by you. In case you don't own the property, then it is not going to be considered as income from property. So basically, the rent received or receivable by a person for a tax year other than rent exempt shall be taxed from tax shall be chargeable to tax under the head income from property. Now let's just start discussing further. If I move a bit forward, so what exactly do you mean by rent? Let's just start discussing. It says the rent means any amount received or receivable by the owner of land or a building. The rent means the amount received by the owner of the land or a building as a consideration for the use or occupation of the right to use or occupy the land and building. The right to use or occupy the land and building, and includes forfeited deposit and includes forfeited deposits paid under a contract for the sale of land and building. Now let's try to understand the concept. What exactly do you mean? It means any amount received or receivable by the owner of a land or building as a consideration for so and so, and includes any forfeited deposit from the sale of a land or building. For example, you enter into a contract to sell a land, or you enter into a contract to sell a land or a building. Now let's try to understand. Usually there is a concept called token money. So you enter into a contract to sell a land or a building, and you get token money from the person whom you have entered into a contract to sell. Unfortunately, what happens is the person backs out. So if the person backs out, the token money is forfeited. You don't return the token money back to that person. So basically, that token money which is forfeited is going to be termed as forfeited deposit. It's going to be termed as forfeited deposit, and the forfeited deposit is also included in income from property, and the forfeited deposit is also included in uh, the rent as income from property. Is it okay? Now, Okay, now let's move a bit forward. So we have discussed that what exactly do you mean by rent. Now let's move a bit forward and let's try to understand. Somebody is asking, Adil Akhtar is asking that what rent are exempt from tax. So what rent are exempt from tax? Basically, if you have got an agricultural land and if you have given agricultural land to somebody on for use, then such rent is actually exempt from tax. Then such rent is exempt from tax. Let's move a bit forward. Now, this is the pro forma for computation of income from property for an individual or an AUP. Now, what exactly is the pro forma all about? It says fair market value of the rent received or receivable. Now, very important concept, fair market value. When we talk about the fair market value of the rent received or receivable, that means that there is a property whose fair market rent is 500,000 a month. You have let it out to your brother for 230,000. So although you are receiving 230,000, but the tax authorities, they're going to add. The tax authorities, what they are going to do is that the tax authorities are going to add 500,000 in your income from property. They're not going to go about with 230,000. The reason behind that is from the perspective of the tax authorities, your rental income is the fair market value, is the fair market rent that should have been received or the fair market rent which is receivable, plus the forfeited deposit, which you know. The third thing is 1/10 of unadjustable advance. Now, this is a very important point. So, I'm going to explain to you that what exactly is 1/10 of unadjustable advance, and resultingly, you get the income from property. Now, try to understand that what exactly is this 1/10 of unadjustable advance. Basically, what happens is I'm going to explain to you the concept of unadjustable advance. Then we can actually go through it also. So generally what happens is if you let out a property, so usually there is an advance rent and also there is security deposit. So I'm repeating it again. There's usually an advance rent and there's also a security deposit. Assume that the property was taken on a rental of 100,000. So the advance rent was 100,000 multiplied by 3 gives you 300,000. And the security deposit was also for 3 months. Let's say it's of 300,000. Now what actually happens is that so we actually know that basically the advance rent was for 3 months and the security deposit was also for 3 months. Now what next is? When we talk about the next concept, then basically this advance rent is going to be adjusted in the subsequent months, which is going to be month number 1, month number 2, month number 3. It is going to be adjusted. But this security deposit is unadjustable. Now, if you consider this concept, then you would say that if security deposit is unadjustable, that means in other way around, you have given your property on rent to somebody and that other person has given you a loan, an interest-free loan in return. So the tax authorities, they say that it's actually a benefit that you are getting because of renting out your property. So according to the taxation rules, the tax authorities, what they say is that what you need to do is that you need to add this 1/10 of this unadjustable advance to your income every year. Like this 300,000 multiplied by 1 upon 10 gives you 30,000. So what happens is every year you will have to include 30,000 in your income from property. Why? Because what happens is the benchmark rate is 10%. What is the benchmark rate? Like we discussed in the income from salary, that if you get an interest-free loan, so what happens is the tax authorities, they impose a tax rate of 10 that impose an interest rate of 10% on it and add it to your salary income. Same goes here also. You have received a loan from the person who has actually taken your property on lease, and if he has taken your property on lease, he is giving you 300,000, which is unadjustable. That's going to remain with you. So if it is unadjustable, if it is going to remain with you, then what actually happens is this 30,000, this 300,000 multiplied 1 upon 10th. So this is 30,000 which needs to be added to the income from property every year. So if I talk about the concept of unadjustable advance here, so this is what the unadjustable advance concept is. Now, let's try to understand another concept. Now, what exactly is that concept? That concept is basically, for example, you had rent out this property for a period of 4 years, and now the existing tenant leaves and his amount is refunded. The existing tenant leaves and his amount is refunded. Now what next is there? The next situation that actually happens is the new tenant comes in and he pays 440,000 as unadjustable advance. He pays 440,000 as unadjustable advance. Now what is actually going to happen now is you would say that amount received from new tenant is 440,000, and what you would do is that you would deduct from it less amount already taxed. So basically 30,000 was taxed for a period of 4 years. In fact, you include it in the tax year in which the property is lent out, but the year in which the property is vacated, you don't add it up. So for example, in the first 3 years, this was added. So this turns out to be 90,000. So if you have got 440 minus 90,000, how much does it turn out to be? So that turns out to be 350,000. Now, if this turns out to be 350,000, then divided by 10, 35,000 is the amount that is now going to be included in the income from property for the subsequent time period. So 35,000, which is basically the amount received from the new tenant less the amount already included in the taxable income pertaining to the previous tenant, is going to be deducted. The balance amount is going to be divided over a 10-year period, and is going to be added to the income from property. Is it okay now? Is it okay to everybody? Okay, so basically this is how unadjustable advance is incorporated. So we now have the provisions relating to the unadjustable advance here, which you could probably see the provisions that I just explained. So this is how the unadjustable advance is treated. These provisions are here. I've explained to you through the example. Okay, so is everyone okay with this? If everyone is okay, then I can actually move forward now. So this is how you calculate the income from property. So I'm repeating it again. This is how you calculate the income from property. Now, there are few exceptions which are mentioned here. Let's try to understand those exceptions. Now, what are those exceptions which are mentioned here? It says lease of building together with plant and machinery. Now, let's try to understand. Lease of building together with plant and machinery. Example is you have a factory where the machinery is already installed. Now you want to rent out that property. So the person who is obtaining your building or your property on rent is actually obtaining it because of the machines. Now try to understand this. The law says if you have lent it out with plant and machinery, then the rental that you received is called income from other source. But you can specifically separate out if you can specifically separate out the rental of building and plant and machinery, then what happens is it needs to be allocated accordingly. Like for example, if the you know that the building, if we rent out the building only, it is going to go for 40,000. If we give plant and machinery to somebody, it is going to go on rent for 110,000. So resultingly combined, both of them are going to go for 150,000. But what we have done is we have let it out at 125,000. So basically what happens is if you do know the individual rental value, then what you would probably do is that you would allocate this 125,000 to both the plant and machinery and the building. So like for example, what are you going to do? You're going to say 125,000 multiply 40 upon 150 and 125,000 multiply by 110 upon 150. So what is actually going to happen is 33,333. So it's going to be 91,667. This is how 125,000 rental is going to be allocated. So first of all, if you have lent out the building if you have rent out the building along with this plant and machinery, then this is actually going to be considered as income from other sources unless until you are able to specifically split it. Okay, the next is amount received along with rental for amenities and utilities. Now, what exactly do you mean by this? Usually, what happens is you rent out a property, and at the time of renting out the property, um, you don't have multiple electricity meters or multiple gas meters. So, what happens is if there are two, three tenants in a property, then what happens is the landlord would say to the tenants that I'm going to charge an X amount in relation to amenities and the utilities. So, like for example, if the rental is 100,000 and you pay 20,000 for amenities and utilities, that is the total amount of 120,000 is paid. So this 20,000 is going to be income from other source, and the remaining 100,000 is going to be uh, rental income. And lastly, depreciation of property cannot be claimed. Even if you are having a property you own, you're renting it out, then what is actually going to happen is it's not going to be considered as it's not going to be considered as an allowable expense. So the depreciation cannot be claimed. Anyway, so we are done with this, and this is actually your income from property available here. I would appreciate if you people can attempt this specific example and try to calculate the income from property. Okay, so what's the status? Okay, so if I talk about this, it says Mr. A had let out the property to Mr. B. What happens is Mr. A had let out the property to Mr. B for a sum of 150,000 per month in July 16. Mr. B has paid a sum of 500,000 as an adjustable advance. Compute the taxable income for compute the income for the tax year 2017. Now let's try to establish it. So what happens is basically the rental income is going to be what? The rental income is going to be 150,000 multiplied by 12, 1.8 million, and 1/10 of an adjustable advance, which is going to be 500,000 divided by 10 gives you 50,000. So it is going to be 18.5, 1.85 million. If I move a bit forward, if I talk about the next thing, it says after expiry of 2 years, Mr. B vacated the premises and Mr. A returned the advance to Mr. B. Thereafter, C acquired the possession on the same rental amount. However, the amount of non-adjustable advance was increased to 600,000. So, for example, after 2 years, what is actually going to happen? So, basically, after 2 years, okay, is there an error for my part? Now, if after 2 years, if I talk about the tax year 2019, then the rental is going to be the same 150,000 multiplied by 12. So, this is actually going to be 1.8 million. And then the next situation is basically what happens is if it is 1.8 million, then unadjustable advance needs to be deducted. So, if the unadjustable advance needs to be adjusted, how exactly are we going to adjust it? So, we're going to say that receipt is 600,000. Already taxed is 50,000 in a year, so gives you 100,000. So the balance amount is 500,000. You divide it by 10, so 50,000 again. So it's actually going to be 1.85 million again in the year 2019. So the tax year 2019, it's going to be the same. Okay, so I hope that this is clear to everybody. So the way you estimate the property income, you do it this way. I did discuss about the pro forma. The same pro forma is actually used for the calculation of the income from property, which is basically fair market value of the rent received or receivable plus the forfeited deposit and plus 1/10 of unadjustable advance. That is how we actually do it. Now, there is another aspect of the income from property, which is actually the income from property for the company. I'm not discussing it right now. I'm going to come back to it later tomorrow or day after when I'm going to be discussing the company concept. So I'll be doing it at that point of time. So I'm leaving behind this specific area. But otherwise, it's actually done. The income from property. Okay, so now what we are actually going to do is uh, when you will go into the handout section of this webinar window, you will find two of the questions. So you have to open the file named PQ 2018, the practice question 2018. You have to open the file PQ 2018. Let's just start discussing about this file PQ 2018. Let's just start discussing about it. It's actually about a person named Anwar, and the requirement of the question is, it says that you have to compute Anwar's taxable income and tax payable for tax year 2018, giving clear reasons, so and so for the inclusion, explanations, etc. Now, what I would want you people to do is to try and attempt this question, and then we'll start discussing later. So let's attempt the question, and then we shall start discussing. You take 10 minutes. We'll discuss later on. Okay. So let's just start discussing about this question. It says Anwar. Uh, Anwar, who is aged 55 years. Anwar, who is aged 55 years, is resident in Pakistan. So he's a resident taxpayer. He commenced business as a sole proprietor on 1st July 2017, manufacturing ready-made garments. Anwar's income statement prepared using accrual basis of accounting for the year ending 30th June 2018 is as follows. So we are being given Anwar's income statement. It says the sales are there, the cost of sales, gross profit, administrative and selling expenses, and then we have got the financial charges. Then you've got an agricultural income. The agricultural income is actually exempt from tax. Agricultural income is exempt from tax, and then there is this PBT. The notes are given. So what I'm actually going to do is that I'm going to review the question, that what are the areas relating to the question. So note number 1, 2, 3, 4, they're all pertaining to the income from business. Then we have been given the additional information. So let's go through the additional information first, so that we could actually compile the information properly. It says apart from the assets mentioned in the above notes, following assets were purchased and used in Anwar's business during the year ended so and so. Machine previously used in Pakistan, so there is going to be no initial allowance. New computers and printers, okay. New furniture, okay. New building including cost of land of 1 million. So what happens is there's going to be initial allowance on building. It says Anwar was an employee of a UAE firm from 1st July 2001 to December 2016. He came to Pakistan on this. On 15 July, he received an amount of 1.3 as a final settlement from his ex-employer. No income tax was deducted by his ex-employer. The amount which Anwar received is not included in the income statement. There are other taxes withheld at source, so and so, and not included in income statement. Tax deducted by scheduled bank on cash withdrawal, along with telephone bills on the educational institutions, so and so. Now, let's just start discussing about it. So the first thing that we are going to do with respect to Anwar is we are going to compute his income. So basically, you need to calculate the income from business. So it's computation of Anwar's taxable income for tax year 2018. Now what next is there? We're going to start off from here. The first thing that we'll do is that we'll start from the profit before tax, which is 1.1 million. So you'll have profit before tax, which is 1.1 million. Then you need to add and you need to deduct, you need to make adjustment. Now adjustment number 1, which is sales. It says the sales figure include 200,000 received from customers in advance of sales to be made in September 2018. So what happens is, what you need to do is that you need to say that the advance received from customer, it is not taxable 200,000, so it needs to be deducted. Why? Because you are following accrual basis of accounting. So what next is there? The cost of sales. It says the cost of sale include 1.5 million for the purchasing used sewing machines imported from China on 1st August 2017 for use in Anwar's business. So what happens is the machine is going to be a is going to be capitalized. It's a depreciable asset. So what happens is you will say that the cost of the sewing machine, which is claimed 1.5 million, it needs to be added up because it's not deductible expense. It has to be depreciated. The cost includes custom duty of 75,000 and income tax paid of 90,000. At the import stage of the collector of the custom, no depreciation has been charged by Anwar on these imported machines. So no depreciation has been charged by Anwar on these imported machines. Now let's try to understand something, that how exactly are you going to account for this. Remember, whenever we purchase something, the cost does not include. The cost does not include income tax paid. The cost does not include the income tax paid. So the cost does not include the income tax paid. So basically the income tax of 90,000 which is being paid at the import stage would be considered as an advance tax. Would be considered as an advance tax. So this would be considered as an advance tax. Okay, what else is there? Let's talk about it. So basically what happens is you'll say there is going to be an initial allowance on sewing machine, and that initial allowance is going to be 1.5 million minus 90,000. The cost multiplied by, since it's a plant and machinery, the plant and machinery is subject to a 25% initial allowance. Why? Because the sewing machine, although it is imported, although it is used, but it's imported. So if it's used, it's imported. So it's actually being used in Pakistan for the first time. If it's being used in Pakistan for the first time, so that means it is how it's going to be accounted for. 1.5 million minus 90,000, it's going to be multiplied by 0.25. So it's actually going to be 352,500. 352,500 is the initial allowance. Then depreciation on sewing machine is going to be 1,410,000, which is the cost, minus 352,500, which is the initial allowance, then multiplied by 15%. Okay, so this is actually going to be 158,625. Now what next is there? So you've got note 2, which was about the cost of sale. Now the note 3 includes, it says admin and selling expense comprise the following: 970,000 paid for the purchase of computer software. Software is likely to be used for 4 years. So basically what happens is the software needs to be capitalized. So 970,000 which has been deducted needs to be added back. And then what happens is there is going to be an amortization of software. So amortization of software is going to be 970,000 divided by 4 multiplied by. Since it is actually August, so uh, August 2017 till 30th June 2018. That means what you could do is that you need to calculate it in terms of number of days. So if I say from the 1st August, 334 days is what it is actually being used for. So this is actually going to be 221,904. What is it going to be? 221,904 is what the amortization of the software is going to be, because it's going to be for 334 days. Now what next is there? The next situation is, it says salary to Anwar's brother who has been employed in Anwar's business as the assistant manager for marketing on 1st June. His brother's monthly salary is 15,000. The salary was paid in cash and no deduction of tax was made from it. So there has to be no deduction, no adjustment in relation to this, because salary exceeding 15,000 paid in cash is not allowed. But salary up to 15,000 is allowed, even if it is paid in cash. Then it says rupees 350,000 paid to a customer according to an order from District Consumer Court for damages. This was on account of supplying defective goods to customer. Anwar has appealed against this order to the Lahore High Court, which is still pending. So 350,000 were paid to a customer according to an order from District Consumer Court. So that is also going to be claimable. Why? because this is actually a penalty paid, but the penalty paid on a business contract. It's not a penalty paid to the government, it's not a penalty paid to the tax authorities, it's a penalty which is being paid on a business contract. So this is actually going to be a claimable expense. This is actually going to be a claimable expense. Okay, let's move a bit forward. Next, it says that financial charges are comprised of following: car lease rentals payment of 220,000 in total, paid to an approved leasing borrower for finance lease on the car used for business. The value of the car was so and so, no depreciation has been claimed on the car. So the car lease payment of 220,000, basically what happens is the taxation treatment is like this. What happens is you don't claim any depreciation. The depreciation is not allowed in the tax rules. Similarly, the finance cost is also not allowed, and all that you do is that you claim the entire rental. So this is also a correct treatment. It says 180,000 profit paid on a loan of 1.5. The loan was used for paying tuition fees for unversed children. So if 180,000 loan was paid for this tuition fee for unversed children, it is not going to be claimable. In fact, loan interest for personal use 180,000, that needs to be added back. If I move a bit forward, so I'm going to say that I've done this sales, I've considered COGS, I've considered admin selling expense, the financial charges also considered this. Agricultural income is added here. Now, since agricultural income is exempt, so what happens is you need to deduct the agricultural income here. Now, what next is here? The next aspect of the question is there is additional information. It says apart from the assets mentioned on the above, the following assets were purchased and used in Anwar's business during the year. Machinery previously used in Pakistan 3.5. So there is actually going to be a depreciation on machinery. So there is going to be a depreciation on machinery 3.5 million multiplied by 15%. Okay, so this is actually going to be 525,000. The next situation is going to be new computers and printers. So the new computers were worth 1.5 million into 30%. So this actually gives you 450,000. What else is there? The new furniture, which is 500,000. There's a depreciation rate of 15% on the furniture. So it gives you 75,000. Then what else is there? You have got new building, including the cost of land, which is 1 million, so 2.5. So initial allowance on building, which is going to be 1.5 million multiplied by 15%. So this is actually going to be 225,000. Additionally, the depreciation is going to be 1.5 million minus 225,000 into 10%. Furthermore, um, we are being told that Anwar was an employee from a UAE firm, so and so, so and so. He came to Pakistan on 15 Jan On 15 July, he received an amount of 1.3 as the final settlement from his ex-employer. No income tax was deducted by the ex-employer. In the UAE, the amount which Anwar received is not included in the income statement. So basically what happens is there is a concept of returning expatriate. There's a concept of returning expatriate. And what happens is the returning expatriate, his income is exempt from tax um, for the 2 years after which he comes back. So basically, if somebody is out of Pakistan for a period of 4 years, and if he comes back in Pakistan, then his income is going to be exempt from tax for a subsequent 2 year period. So his income is going to be exempt. So resultingly, what happens is we'll have the taxable income here, and then there is this exempt income, which is 200,000. So you end up getting the total income. Can somebody please do the total, please? Yeah, can anyone please do the total? Okay, I'll explain the UAE income, don't worry, just wait. Okay, can somebody please do the total, please? Okay, I think your you people are quite slow on the calculators, but anyways, whatever the computation is, let's assume that whatever the answer that comes out, you'll add this much to become the total income. Now, what is going to happen next? The next thing that is actually going to happen is the tax liability is going to be computed. So whatever the taxable income, the tax liability is going to be computed, and then less the tax already deducted or paid. Now, what is the tax that already deducted or paid? 5,000, 30,000, 4,000. So this is actually going to be 39,000 here. Is there any other tax that is already deducted? Yeah, this 90,000. So basically already deducted is 90,000 plus 90,000 plus 5,000 plus 30,000 plus 4,000. This is what is already being deducted. So the net amount is going to be established like this. So basically that marks the conclusion of this specific question. Now there was one aspect of the question which I did, there was some error. In fact, there was some problem in understanding that, and that was basically this specific adjustment. So for the timing, I would say it pertains to the foreign source income. Let's actually skip it right now because we'll come back on it later on, that how exactly to deal with the foreign source income. But other way around, this is how the income from business is computed and determined. Is everyone okay with this? Is everyone okay with this? Okay. So that marks the conclusion of this question and of today's session also. We will keep it till here, and inshallah we will inshallah be discussing further tomorrow that how I mean the other aspects of the this taxation. So if anyone has any questions, if anyone has any problems, you can ask, or if you would like to make any comment, anything, please be very open and give your comments and feedbacks. They are highly appreciated.